Hello and welcome to Portfolio Matters Week 20 Weekly Update. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Thank you, Richard. Okay, this week, well, in terms of news, there was not that much. UK inflation came out, and as expected, it was strongly up on March. So April CPI came in at 1.5%, March CPI was 0.7%. So you've had essentially a doubling of the inflation rate, although it is still below the Bank of England target. Now, you've seen from regular weekly updates that there has been an enormous surge in commodity prices and input prices, and we expect inflation to keep rising with a lag. So over the next few months, I strongly expect inflation to keep rising above the Bank of England 2% target. Now, the open question is whether that is transient or will lead to longer term high inflation. Now, currently, as we will see as we go through this, the market's inflation expectations are well anchored. So everyone is expecting a transitory inflation episode. Okay, so this is from the FT and it shows CPI in pink. So you'll see that the April number is up to 1.5%. But remember that there have been cuts in VAT and various other indirect taxes because of coronavirus. And if you were to add those back in, then CPI would actually have come in over 3%. Now we know at some stage those taxes are going to have to be reintroduced, at which point inflation really beats the Bank of England's targets already.
That's so interesting, Keith, isn't it? Because it also shows that there is strong underlying inflation in the basket of goods that's measured excluding those indirect taxes, which is actually what we'd expect given the commodity increases and supply disruption that we've been seeing. I also know that all central bankers in the world are telling us that the inflation episode is going to be transitory, and none of them are saying anything other, which seems to me remarkably like a coordinated approach. Well,
that's their job, which is trying to keep confidence in the banking system and the central banks, and I fully expect them to talk the talk at all times.
So Keith, one thing I think is interesting is that when real GDP growth is small and inflation is equally small, you can have a significant effect of on real GDP growth with small changes in the inflation rate. So for example, if real GDP is 100 one year and then goes up to 102 the following year with 2% inflation, if inflation was actually 4%, your real GDP would not go from 100 to 102, it would remain at 100. And if inflation was 5%, your real GDP would actually go to 99%. You would have, in fact, deflation. And because we're operating on the margins of low growth, it's very easy for, if the inflation number is a little bit wrong, to switch the sort of binary switch from positive to negative real GDP growth, i.e. deflation to inflation. And I suspect central bankers are desperate to keep the inflation rate low because GDP growth rate is low, and by keeping the inflation rate low, they maintain positive real GDP growth.
That's an interesting point, Richard. One thing I would say is that actually, I think what really matters is nominal GDP growth. And so, because we have an enormous amount of debt, and nominal GDP growth is necessary for eroding the debt, because the debt doesn't change. So
yeah, and exactly so. Yeah, but of course, if real GDP is negative, then that's a disaster from an economic point of view, from a political point of view.
Yeah. And this should continue on the inflation theme. This is UK factory output inflation, so price of goods leaving UK factories, and it is shooting up.
I think the fascinating thing about that, Keith, is it's actually shot up 6%.
Yes, yeah, you're right.
It's extraordinary.
But on other matters, the day traders are returning to their jobs. You know, everyone has been stuck at home playing around in the stock market, in options and GameStop, but now they're going back to work, and so options trading in the US is in decline. So maybe we will see. Go on, Richard.
I also wonder, Keith, we know the market makers got wise to the retail-linked option play, and one wonders whether a lot of retail-linked option plays lost money, frankly, once the market makers got wise to it. People have been pushed out of the market because they've lost their stakes. It wouldn't surprise me in the least.
No, I think you're absolutely right, Richard. This is credit card spending in the US, and the orange line is the trend from January 2020, pre-COVID, and it shows that we are now back to essentially flat. So the US economy, US consumer has completely recovered from COVID. And if you look at it on a 2-year view, and that is the blue line, consumer credit card spending is up 14.2% on 2 years ago. So the US consumer is strong.
I think we need to put recovered in inverted commas, don't we, Keith? Because, of course, the vast sums of money the US government has been pumping into the economy will have impacted this.
Yes, no, that's absolutely right. They've got savings. Okay, and this is a great chart that was sent to us by Herman, our American viewer. And what it shows is the blue line is US sales, retail and food sales, and the white line is inventories. And for the first time in history, the sales have actually outstripped existing inventories. And so US retailers are in a desperate scramble to get hold of stock, essentially, and that is why you're seeing everything spiking. Suddenly there are supply chain blockages, and sales have outstripped inventories. And as evidence of that, the Bloomberg Commodity Index has shot up to its highest seen on this chart on a year-on-year basis, highest ever since 1996. And unsurprisingly, inflation expectations are rising, although they remain, frankly, pretty subdued by historic standards, given everything that's going on. So the blue line is the US, is the 10-year break-even rate, and that's 2.5%. I mean, frankly, I think these are really quite well anchored, given everything that's going on.
The interesting thing about the inflation, whether inflation is transitory or not, Keith, if you just pop back to the previous chart, clearly these are the input prices now for items that are being manufactured. And the question is, if it's going to be transitory, not only do these numbers need to effectively start, the year-on-year needs to go down, but in what period of time is transitory? Because if it takes 6 months to go from a raw material to a good on the shelf, then that transitory period is 6 months, even if these prices start going up now. And so there is if the prices drop tomorrow, there is a follow-through effect that is complex, but it won't immediately reflect itself in the inflation rate.
Absolutely. Well, the big question, Richard, is whether, as inflation rises, and it will, whether that leads through to increases in wages.
Yeah.
And then you start to get an inflationary spiral.
Yeah. So
for more on inflation expectations, and the five-year forward break-evens, which is the blue lines. So that's what, in 5 years' time, what people are expecting over the next 5 years. And that remains actually pretty well subdued. You're talking about 2.3%, 2.4%, and that is, within the kind of Fed target. So people are buying into the argument that this inflationary episode will be transitory. And okay, I'd like to talk a bit about a good piece by Lynn Alden I listened to during the week, and she has a website. Actually, the source should be lynnalden.com here, apologies, which you can register and subscribe to her newsletter, which is free and comes once a month and is very good. And she makes the analogy with the 1940s, and she draws a strong distinction between the inflationary episodes in the 1940s and the 1970s. So in the 1940s, inflation was caused by government spending associated with the war. So there was very large fiscal deficits. Whereas in the 70s, the inflation was caused by the private sector, in particular, very strong banking loan growth, and leading to wage growth and a spiral. And her point is, in the 1940s, because the inflation was essentially caused by the government itself, the central banks did not respond. They were quiescent, and they allowed inflation to rip because that suited the government, because it eroded the debt burden. Whereas in the 70s, when inflation was being caused by the private sector, then they responded strongly. And you can see the blue line in the bottom chart is it's the red line in the bottom chart is US rates. And you can see in the 1980s, the rates got ahead of inflation, and that killed inflation.
So it'd be interesting. It would be interesting to have the debt burden as a percentage of GDP on that graph as well, because of course central banks, in my view, will not be able to raise interest rates to counter inflation if it occurs, because the debt burden is so great they'll crash the economy and burst numerous financial bubbles, and it's unconscionable for them to be able to raise rates to counter significant inflation. So I think the circumstances are very different today, aren't they?
Well, my point was going to be, Richard, I mean, you raise a good point, but my point was actually going to be that I appreciate her analysis, but I think it's very dangerous drawing these historic analogies because times change. And the difference between the 1940s and the 1970s and now is that we have independent central banks. Now, the reason that the US in the 1940s could not respond at all, the interest rates could remain at zero, is because the central bank was an arm of government and it suited the government. Now, nominally now they are independent and they should be trying to stop inflation.
I think if a central bank went directly against the government's wishes, it would find it wasn't independent for terribly long.
Well, that may well be true, but there are very big consequences to that, because the thing is, Richard, if inflation expectations become unanchored and so people lose confidence in central banks, then you'd expect to see bond yields spike sharply. And that would have huge knock-on effects given the debt burden. So we are in a trap. It
would indeed. I absolutely agree, Keith. They can't raise interest rates and they can't not raise interest rates. The consequences of both courses of action are dire, and they are stuck there. And I think trying to predict what the route out of it will be, because inevitably, over 50 years' time, people will look back and say, and that's how it ended. But how it will end, I don't know, beats me.
Well, I think our advice is just to remain nimble on your feet, not be too prescriptive. Just see how things develop and switch accordingly. Richard.
Oh yes, so this is the share of gross domestic income to employees as opposed to businesses, and effectively what it's showing is that employees' share of profits in the United States have dropped from in the 1970s from 50-odd% down to 43% now, and which reflects increasing profitability of businesses and a reduced share of the pie for employees. And I think we are, there are a number of reasons why this has happened, but we talk now of this sort of huge inequality between the wealthy and the rest of the population. That, I think, is a reflection of this. We have the rise of populism, which I think is also a reflection of this. And we have the more and more sort of monopolistic or oligopolistic behavior by big businesses in I think actually in all Western economies, the sort of slow reduction of choice. And that enables them to have much more power over their workers because there's less competition for staff. And at some point it will have to reverse and go back up. And if we have inflation on top of this, we want wage inflation, then I think it gets very messy potentially. Well, what do you think, Keith?
I agree with your comments, Richard. We read a very good book which we would recommend called The Myth of Capitalism by Jonathan Tepper, which talked about the lack of enforcement of competition policy across the Atlantic, leading to market concentration and greater power for the companies in terms of buying power and also monopoly power in hiring. So they have been able to suppress wages. And one of the things Joe Biden is attempting to reverse is exactly this chart. He's attempting to raise the labor power and the labor share of the wealth of the economy, and that has to come from somewhere. And if he's successful, then corporate profit margins will be squeezed.
He will have to give antitrust legislation teeth, and the powerful lobbyists who pay a fortune in America will not like that.
No, exactly. Let's see how he gets on, essentially.
Watch this space.
Now, moving on, this is the forecast to be the shortest recession ever, basically. The black line is the S&P consensus earnings forecast, and you see that they are forecasting that within 2 years from the start of the COVID recession, the S&P earnings will be back to normal, whereas in normal recessions it takes much longer. And on that same note, this is the unemployment, which appears to be coming down incredibly quickly, and they are now forecasting within the next 18 months that full employment recovery in the US. Now, of course, last week we covered the fact that April employment numbers were actually disappointing. So this may be optimistic.
Well, if you look at the next two graphs, Keith, this is the chart that I put up from time to time. The total small business revenue has basically not recovered since May 2020, and it's bumping along at around about minus 30% of pre-COVID level. And if you look at the following chart, which is small businesses open, it's around about 35% below pre-COVID levels, and it is on a gradually sloping downtrend. Now this contradicts full employment, or employment recovery rather, and it contradicts a short, sharp recession, because this is going the wrong way. So there's some contradictory data out there. And the longer a small business stays shut, the less likely it is to reopen. And I suspect what's happened here is businesses are shutting and have shut and won't reopen, and their replacements have yet to be born.
Well, I think there's really interesting charts, Richard. Thank you. And you're right, these are very contradictory. But one thing we know is that there were a record number of applications to start new businesses in the US, and we're just not seeing that yet. Not seeing that in the numbers.
This is true.
Okay, moving on. This is a series of 3 charts, just as an aside about the effect of home working. And these are all from John Authors of Bloomberg. And so this shows the number of hours per day of the average worker before and after home working. So the switch to home working caused a substantial increase in hours worked. So prior to home working, people were working on average 5 hours a day, and then afterwards they're working 7 hours a day, and that is an enormous increase. So part of that can be explained by them not having to commute and using that time to work instead, which is great. However, if you look at actual output, bearing in mind hours worked has gone up 40%, then after an initial, frankly, tiny increase in output of less than 1%, it's fallen back again. So people are working 40% more hours, but there's been no change in output, and that means productivity has collapsed.
I think this is really interesting, Keith, and it sort of jives with one's own experience of people one speaks to, also one's own understanding of how well one would work, working entirely from home without any social interaction with one's work colleagues. And I think working from home, doing these things via Zoom, you lose so much informational input that doesn't come from simply verbal exchange of information. And human beings are social animals, and this concept that Zoom replaces the office is utterly flawed.
So that's, you've increased your hours sat in front of the computer by 40%. Yes. You claim that's work.
Yeah.
How many of that's watching cat videos? Okay, on to the weekly checklist. And the all share was flat on the week. The S&P had a good week, up 1.1%. The Nasdaq recovered, up 3.1%, and it's no coincidence that rates fell back last week. And so Nasdaq is full of tech companies which are long duration assets essentially, and as yields fell, then the Nasdaq recovered. The Japanese Topix was up 1.2%. Bitcoin had a terrible week, but I will leave that to Richard to talk about. And sterling continued strong, up another 0.8% last week to 142 against the dollar. So last week we had some gyrations, and you can see the sentiment index was down. So people have become, as we've discussed many times, we're entering the May-June traditional pullback period, and sentiment is following that downwards. And now, regular viewers will know that we expect inflation to rise and therefore rates to rise, and that to be bad for technology stocks which have incredibly high multiples. I mean, Tesla is on a PE ratio of something like 320. And so this is the performance of value and growth stocks in the aftermath of the tech bubble in 2000. And you can see tech stocks fell by 60%. This is the index on average. Whereas value stocks, they were pretty flat. They had their own drawdowns in 2002, but then after that they outperformed strongly, and they outperformed technology in the next 5 years. And that is the pattern, frankly, I'm expecting to see. Richard.
Cryptocurrencies. So the question is, what happened? Why did Bitcoin and all the other cryptocurrencies virtually have such a dramatic drop? I think there are probably a lot of reasons. Biden targets cryptocurrency trades and moved to crack down on tax evasion. Yes, I'm sure. The Elon Musk, who is seems to be a hugely powerful influencer, said that Tesla would no longer accept Bitcoin in exchange for its cars. And the rise has been so meteoric. There were probably an awful lot of highly leveraged players, and it didn't take very much to shake them out. I suspect that there are people out there who make quite a lot of money by pushing the price around a bit, and so if you have a large position, either leveraged or too big a position with your own money, one's very nervous and it gets easily bounced out of it. Anyway, for whatever reason, many reasons, Bitcoin went down dramatically. We can see here that Bitcoin dipped down to the 618 on the Fibonacci and then bounced back up to around about 50% retracement. I mean, it hasn't really gone anywhere very far since March, I think, and it does have these very, very large movements, and you do need to be not leveraged and not too big a position in them. This is an overlay from Raoul Pal, he's the founder of Real Vision, and it's on his Twitter account. And it's an overlay of the current Bitcoin price with the Bitcoin price between 2010 and 2013. And it does actually follow quite remarkably closely the same profile. And if you're a believer that history is going to repeat itself, the suggestion is that the price of Bitcoin is going to go significantly higher from here, bearing in mind that we have a logarithmic chart.
Interesting. Well, I have to say, Richard, that as a Bitcoin skeptic, I was actually incredibly impressed by the strength of the bounce back, because you talked earlier about how many people hold Bitcoin with leverage, and when it fell 35% in the day, all those people get wiped out. They get called from IG Index saying you owe us a load of money because we've closed you out of the bottom here. But then it bounced back very strongly, and that requires new buyers. Yeah. So I personally was very impressed by that. Now, one thing that actually I found quite interesting was on the day that Bitcoin fell very heavily on the back of the Chinese cracking down on Bitcoin. Actually, there's a very strong correlation between the Bitcoin price and the S&P. So the S&P opened lower and then recovered with Bitcoin. This suggests there's kind of commonalities in speculation between the two. And this chart shows that inflows into Bitcoins, the various crypto funds, and gold. You can see that recently there's been flows out of Bitcoin and into gold, but whether that's coincidence or not, we'll need to see over the next coming months. Richard.
Thank you, Keith. So this is a chart of Ethereum, which has got a slightly different shape graph to Bitcoin. It hasn't had that sort of going nowhere for 2 to 3 months that Bitcoin has had. It dropped to 20,000, so that is something like a 60% drop in over the course of about 2 weeks, and extraordinarily painful for anyone who's leveraged or has too big an investment in it. I think we have to remember, don't we, that even if these cryptocurrencies do find a use in the technological world of the future, that it's not going to be a straight line getting there, that nobody really knows what their value should be or will be, their uptake will be, or whether they will be made obsolete by some additional technological advance. We can't see the future. So fundamentally they are speculative assets, which makes them very difficult to value, but also which means that people are very, very nervous and not very strong holders. There are a few very strong holders, but many people are not strong holders, which clearly contributes to the extraordinary volatility that you see.
Absolutely, and that's what impressed me about Bitcoin. The fact it bounced back so strongly, because people hold these, in my books, as speculations, and in which case you only want to see it going up. The moment it's flat or it starts to drift off, you have no incentive to hold it. So, anyway.
And our favourite chart, the Shitburp crypto chart, which took a bit of a tumble, didn't it? It's gone from 10,000 to 6,000, so that's a nice 40% drop. But it has, along with Bitcoin and Ethereum, it has perked back up by, actually, as Keith said, about 15% bounce. I suspect that the price of these things, just generally all these cryptocurrencies, is not really going to go anywhere for a while. It'll probably take some time to recover from these very sharp falls, if they do recover from these very sharp falls. These are two interesting graphs that I came across. The budget deficit as a percent of GDP in white, the dollar basket DXY in orange, and this indicates, if you think that the orange line of the DXY should at some point meet the budget deficit, you would see the DXY dropping, and it has recently just dropped below the 90 point, we'll see. The next one, I think, is the US trade deficit versus the DXY, which also suggests that the DXY should drop, in this case down to 75, which would be not unprecedented, but a very big drop from here, and would have all sorts of impact around the world.
Well, the one thing I'd say
in the US.
What I'd say, Richard, is that both these charts show that the US is running a current account deficit with the rest of the world, and that should place negative pressure on the dollar. So the dollar should fall. So in order to offset that, it needs capital account inflows, and so what you would expect is that the capital account inflows need to be incentivized by higher rates in the US compared to the rest of the world. And if US rates do not rise, then the dollar will come under a lot of pressure.
Yes.
Okay, so on to the weekly commodities checklist, and it was generally a bad week. So aluminium down 1.2%, cobalt down 2.2%, copper down 1.6%, but still very high. Chromium was flat. Iron ore came off an extraordinary spike, so it was down 5.7%. You will remember that last week it was up 10%. Lithium was flat. Neodymium is coming off. That was down 5% on the week. We've got the chart for you in a second. Nickel was flat. Vanadium, on the other hand, is perking up 4.8% on the week. WTI had a bad week. We'll have an extended chat about crude oil. And uranium was up 0.5%. It knows you sold it, Richard. Okay, so let's have an extended chat about oil. Now, one of the reasons that oil was heavily off this week was the IEA, which is the International Energy Agency, which is funded by OPEC, although it is nominally independent, came out with a report giving a pathway to zero carbon emissions by 2040. So 2050. Now, this is their pathway. Now, two things to notice. First of all, the total amount of energy consumed by humanity needs to fall by probably about 7 or 8%.
Well, that's a bit of a tall order, isn't it? Considering that both third world countries are rapidly becoming more technological and more sophisticated, and they require vast energy inputs in order to achieve their goals. That seems, on the face of it, seems really quite unrealistic, Keith.
The other thing is the enormous increase in renewables, almost all of which is wind and solar. Hydro is, those are mainly been already utilized. And if we move on, this is world energy consumption since 1800. Source this, so the last data was actually 2019 on this chart. Now, the thing that I would like to emphasize about it is just, if you look at this, how much is fossil fuels? It's absolutely enormous.
Yeah. And also, sorry to interrupt you, but just to go back, the point of the last slide is humanity energy consumption needs to plateau. Well, it's not going to plateau, is it?
No.
Looking at this graph, even if it were to level off, it's going to be leveling off if you take the shape of that graph, it might level off at 250 terawatt hours or something, 250,000, I don't know, but it's not going to plateau between now and 2050.
Yes, exactly. Everyone in the developing world aspires to Western lifestyles, and that requires an enormous amount of energy. So, but the other thing I wanted to say was that currently wind and solar are only 3% of the energy mix. And in order to get to net zero, you're going to have to substitute not only the oil and gas, gas, oil and coal on this chart, but I expect energy consumption to keep on rising, and then so it'll have to grow in addition to the substitution to allow for the energy uses of emerging markets. So this is the data from that table, and it's 2019, and so the chart is from the World in Data, which is an excellent source which I recommend. And the IEA is saying that by 2050 wind and solar would need to be 70%, and we have calculated, in order to get there, and assuming that there is no increase in overall energy consumption, which is a big assumption, that you would need 11% compound growth over the next 30 years to get to 70%, and that is actually only 11% per annum.
Yeah.
So, but last year it was 8% wind capacity growth, and solar was 5%. So even now, when everyone is talking about it, we are below the investment required, and it will only get harder as the most favorable solar and wind areas are developed first.
They're filled up. I think also, Casey, we say, okay, we've calculated it as 11%. I've just actually, while you were talking, I just said, well, what if you sort of double the 70% because world energy consumption continues to go up, and it comes out about 15% annual increase. But one of the issues for these is the availability of resources. And the resources aren't available for a compound annual growth rate of these sizes in these generation protocols. They just don't exist. Bearing in mind that most of the resources that are used now, many of them are used in other activities, and the amount available for alternative energy is not everything that is mined. It's a fraction of everything that is mined. So whatever these compound rates are, the compound rate of growth of extraction needs to be much greater in order to hit these targets in inverted commas. And I mean, we've got to the point also, haven't we, where we're saying, you can quite glibly say, not you personally clearly, but it can quite glibly be said that we need to, growth rate of this and this will achieve it. But no one is discussing the infrastructure, the detailed infrastructure requirements and how we get there.
Absolutely.
So this is a graph of the EU carbon price, which, as viewers who watch our regular weekly updates know, I've invested in an ETF that tracks this price. And the purpose of the EU carbon price is to tax effectively carbon production from manufacturers. Ultimately, we as individual consumers pay for it, but it's not a direct tax, an indirect tax. And the price is going up quite dramatically now with the emissions targets that have been set in many of the first world countries. And one of the interesting things I think here is that the price of carbon can't go up at this rate without some of these products being priced out of the market. And then I'm not quite sure what happens, because that starts to have a knock-on effect on industrial production, inflation, and employment.
Well, it's going to be very interesting to see how this plays out, Richard, because essentially we have exported a lot of our industries, which are very carbon intensive, to China. And if we then start taxing all carbon intensive production in the EU, we're going to have to put taxes, carbon taxes on imports from China. And whether that is allowed under the WTO or whether that's possible, I don't know. But also, this is incredibly inflationary.
I read the other day. I read that China is treated as a second. I don't understand the details. I think it's a second world nation under WTO rules, and therefore not all the environmental regulations apply to it. And there is a campaign in process saying China is not a second world.
Yeah.
It's a first world producer, and therefore it needs to have harsher environmental rules imposed, obviously, which then increases the pricing of its products to put them on a level footing with the G7. So, as you say, an effect on inflation is going to be extraordinary. So this is just one of these searches you can do. The use of the word carbon in earnings calls. What this shows is that everybody is talking about carbon neutrality and removing carbon dioxide from production processes and so forth. And it just adds to the sort of frenzy, I think, the hyperbole that is going into the debate. And as I emphasize, I am very keen on decarbonising the planet. I can't see a reason not to do it, but we have to do it in a rational, careful way.
Well, I agree, Richard, that we need to decarbonise. However, my frustration with the whole debate, particularly in the UK, is there's a lot of platitudinous virtue signalling about how everyone, we've got to get to target zero, etc. But nobody talks about the costs. And I'm actually quite impressed by the carbon tax, because the reality is this is going to cost a vast amount of money. Investing in all these wind farms, in solar, etc., etc. It's very easy to just set targets and say we're going to do it. It's an entirely different thing to actually go about doing it. And actually, we are not anywhere near investing enough to get remotely close to these targets. And actually, when I look out of my window in North London, the number of gas guzzling 4x4s vastly exceeds the number of electric vehicles, and electric vehicles are much more expensive than small cars, and you are asking people to spend double on the equivalent electric vehicle they can buying a small Honda. And until you get government incentives which either heavily tax petrol and subsidize electricity, you need to do something. We need to have a sensible adult conversation about costs and how we're going to do this. I
think there's another point there, Keith. I absolutely agree with what you say about the cost of them. But electric vehicle carbon, the carbon neutral point of an equivalent electric and an internal combustion engine is something like 120,000 miles. Obviously, the internal combustion engine produces a lot of that CO2 during the course of its life. So but the lithium batteries are highly CO2 intensive to make. So you get a pulling forward of the carbon emissions as you move to electric vehicles. And then, of course, if the electricity is generated, as we all know, with fossil fuels, you are, again, to use the analogy twice in one podcast, like a hamster on a wheel. You're running really fast and going nowhere. And then we come back to the issue of being able to green the power supply industry, but not having the resources to do so.
Okay, moving on. Well, let's talk about oil for a minute. Because, as regular viewers will know, I am very heavily invested in oil. And over the last oil cycle, the US shale essentially destroyed the oil market through its productivity. It produced much more, much faster than people were expecting, and it destroyed the oil price. Now, you remember a few weeks ago that we covered this chart from the US energy analyst Art Berman, who was forecasting that US oil production would start to decline in May and June, July of this year because of the lagged effect from the reduction in the rig count 12 months ago. So this blue line is the lagged, 12-month lagged rig count. And so he was saying it takes 12 months essentially to drill, frack, and complete a US shale oil well. And from March, April, May, you should see a big decline in US oil production. And the bottom line is we're not seeing it. Now, the one thing you know is that shale oil well productivity has peaked. So this chart shows the production rate of shale oil wells in the US by year. And you'll see that the topmost line was 2019. So actually 2020 was very similar, but 2021 is actually coming out lower. After 2 months, average daily oil production in the Permian Basin, which is by far the largest, is actually substantially down on 2020. So shale oil production is not being driven by increased well productivity. I put together this chart using EIA data, and the red line at the top is US shale oil production, and the yellow line is the number of wells completed, the orange line is number of wells drilled. And so what is really puzzling me is why US shale production has remained high when the number of wells completed has dropped substantially and the number of wells drilled has dropped even further. And the gap between the completed and the drilled line is caused by companies completing wells they've already drilled. And those are called drilled uncompleted DUCs. And if we move on to the next table, what you'll see is there's actually an enormous inventory of wells that they'd previously drilled but didn't complete. And if you look at it, so last month they completed 241 of these DUCs, brought them online, but they still have another 2 years worth of inventory. So I'm puzzled essentially by why US shale oil production remains so strong. If anyone has any ideas, please get in touch. Okay, moving on to the industrial commodities. Copper had a bad week, but frankly, I mean, it's had an absolutely amazing run, which remains pretty solidly intact. I mean, it was off a bit, but this still looks like a straight line up.
Yep.
Iron ore, I mean, that spike over the last few weeks was extraordinary, and it's coming back off. I mean, but still, you'd say a straight line was still intact. Lithium is pretty flat, seems to have reached a plateau at the top. Richard?
So there's rumours that the Chilean government might effectively nationalise lithium mining in Chile. And I think this basically just, whether they do or not, remains to be seen. But I think what we have to bear in mind is that there really is jurisdictional risk in a lot of these miners. And I think South America is an area of significant jurisdictional risk as well. And personally, I steer clear of South America with my resource investments for that reason.
Well, it's very difficult to stick clear of copper in Chile, because Chile is the world's largest producer by quite a long way. Now, neodymium is coming right off, so it's had this peak, and it's it's down 5% last week. Now, people who watched our talk on neodymium and the market for rare earths will know that we were skeptical about the long-term chances of neodymium and rare earths because of all the development. But frankly, we're expecting that in a few years' time, not now.
Yeah.
So, but one commodity that has done well this week is vanadium. Ferrovanadium was up almost 5%, which is very good for holders of Bushveld and potentially ferroalloy resources.
Yeah. Well, uranium hasn't gone anywhere very much for a long a long time now. We shall see. People who watched last week know I've actually changed my view on uranium, and I'm now coincident with the view that Keith has always held,
which is skepticism that we're entering a super bull market, basically. Okay, on to precious metals. Well, as you know, rates had a poor week, so yields were down, bonds were up last week, and gold has an inverse relationship with rates, and as rates fell, gold picked up again, up 2.3%, silver up 1.6%. The platinum group metals actually had a poor week after a very strong run. So platinum was down 1.8%, rhodium 1.4%, palladium 1.5%. Richard?
Graph of spot gold. If you look at the sort of downtrend that we've had since last summer, it's broken through that downtrend. The moving averages have all turned up. It's broken up through all of its moving averages, and it looks actually quite a strong chart now. And I know various chartists are prognosticating that the next high it'll hit will be 2200. I don't prognosticate that, but I do think that the chart does look strong, and it seems to have overcome the prolonged bout of weakness.
Yeah, I agree. It does look strong.
This is a graph of gold versus real interest rates. So as real rates drop, the price of gold goes up, as Keith was just saying. And what this chart was slightly out of date, and just by a few days. And what has happened in the last few days is the price of gold has gone up to meet the real interest rate line at around about a price of 1880. Hence the red arrow. This is a graph of the junior gold ETF, GDXJ, and it sort of mirrored from last summer. It mirrored the slow decline of the price of gold, and it is now mirroring that breakout that we saw in the gold chart. And as we know, gold miners are leveraged plays on the price of gold because the profitability goes up disproportionately to the increase in the price of gold. And so if gold moves up, you would expect GDXJ to move faster in percentage terms.
Silver following gold up. Platinum seems to have plateaued for a bit, actually, after a decently strong run. Rhodium, similarly, not coming off, but has ceased climbing. Palladium, on the other hand, has come off. Yep. Onto rates now. So bonds had a good week. Yields were down, so bond prices were up. And so the UK 5-year was down 3 basis points to 0.365%, and it was down. The yields were down all across the board. But you know, long term, UK 30-year is only yielding 1.388%, which 5 years ago you would have thought was absolutely ludicrous, even before you knew that CPI was picking up. Now, and RPI in April was 2.9%, CPI 1.5%. As bonds prices have ticked up, so investors actually have been more returned to bonds, having fled bonds for equities on fears of inflation. In the last couple of weeks, that has reversed. People have started buying bonds again. This is the UK 30-year gilt chart, which has come off in the last few days, but the trend would seem to be strongly upward, and as you would expect with rising inflation, similar chart in the US. And finally, moving on to our favorite chart, the seasonality chart, and you can see actually we're now moving into quite a strong period for the market before the summer troubles. So
are you saying, Keith, people should go out and fill their boots until 7th of June?
We try not to give advice on this channel, Richard, but so far this year, this chart has been uncannily accurate.
It has, hasn't it? It's remarkable.
Yeah. Anyway, do you want to move on to your activity, Richard?
Thank you, Keith. So this week, my portfolio was down 0.3%. Got knocked, obviously, by the drop in Ethereum, and there was, I think, my mining shares on average during the week did quite well. So effectively, the two movements seem to balance each other out. My purchases, I bought Garibaldi Mining, which is on the Toronto Stock Exchange, and I sold the remainder of my Geiger counter. So I now no longer have any uranium investments, and my average profit on my Geiger counter investment trust was about 35%, which is not bad. Our holding was for probably 18 months to 2 years. So Garibaldi, well, the first reason for buying Garibaldi, frankly, is this fabulous photograph that they have of their Nickel Mountain resource. And I would love to go walking there, but it is in British Columbia, so it's not terribly accessible. So they have this resource of nickel Mountain. So magmatic, I don't know what that means actually, nickel copper rich, massive sulfide deposits, and this is directly from their publicity. Given the battery arms race that's only going to intensify, these are more valuable than ever. So, but what they discovered is it said 8.3% nickel, 4.2% copper, cobalt, platinum, palladium, silver, gold, and so it appears to be a very large, high-grade nickel resource. Now we know that nickel is currently really not in deficit, but it is projected to go into deficit in about 4 to 5 years' time. So I bought this on the basis that nickel will be going into deficit and the price of nickel will go up significantly. The price of Garibaldi has not gone up significantly. In fact, it's bumping along its lowest price where it has been for the last 2 years. So that's, I think it's quite an interesting company. They have a couple of other resources as well. But,
Richard, before you move on, where are they in terms of development? Have they got funding, or what's happening?
I think I should do a share talk on it, Keith, for much more detail.
Yeah.
So that's a good question. And then I just thought KFA Global Carbon ETF, which I referred to last week, I bought last week, had a bit of a horror the other day. It was down 5%. But as you see from the line that I've drawn underneath it, it basically probably got ahead of itself. So I'm still holding on there, and that's my weekly update, Keith.
Okay, thank you, Richard. Well, I'm afraid I had a poor week again. Oil came off heavily, and actually I didn't lose as much as I possibly expected to, given the preponderance of oil companies in my portfolio. I was down 0.7% on the week, which takes me to plus 5% year to date, which is substantially below Richard and below the all share, which is all rather disappointing. I sold my Vodafone this week. Sadly, I was away hiking in Wales when the bad results came out and Vodafone sank. So I sold it as soon as I came back to the UK, to London. It's I bought it as defensive, and I think there's limited upside and there are better uses for my capital, basically. Having made 8.8%, I didn't buy anything. To be clear, I now expect the market to go into a period of quiescence and to be down, as it always is in June, July, and I'm expecting to pick some stuff up, hopefully at lower prices in June. Now, a couple of my companies had updates during the week. Now, Castillo Copper announced the results of their latest survey, and it's interesting. Now, their previous drills were this anomaly in the center of the screen, where they reported a small ore body but with high grades. Now you see their latest survey shows a much larger anomaly far left, and with the new drilling campaign, hopefully could be some good results coming out in a few months' time. So that should be great. And this is the share price, and you see that previously it spiked up to 4.4, and this is a company that is at the right stage of the development cycle where good exploratory results should result in share price performance. So that's what I'm hoping for.
Fingers crossed.
Now, the other company to announce this week was Anglo-Asian Mining, which we did a share talk on several months ago, and that is a gold and actually now an increasing copper miner in Azerbaijan, which people who have watched the share talk will know that it has got back some of its contract areas in Azerbaijan which were formerly under Armenian control as a result of the recent war between Armenia and Azerbaijan. Anyway, the results were pretty good. Turnover up 10%, operating profit after tax up 20%. Now, what I thought was interesting was that the copper production has really picked up. So up 17%, and they're guiding to between 2,500 to 2,800 tons this year. So that's 5 to 6 million pounds of copper. That's, you know, getting to be quite substantial amounts of copper now. In contrast, the gold and silver production was actually down, although they're forecasting recovery in their gold output this year. Now, one of the reasons I was interested in the shares was because of the these contract areas, which included the massive Zod gold mine, which was formerly occupied by Armenian forces. Now, unfortunately, the news there is not good, in that they have gone to some of these restored contract areas, but only with an armed escort. So I think it's going to take quite a long time, i.e. probably years,
oh dear,
for them to get back control of these mining areas. And that is it from me, basically, but the market liked the results. So anyway, it's been a long one. Thank you very
much, Keith. Thank you very much.
Great. Well, thank you to everyone for getting to the end, and in the meantime, please can you press like and subscribe to our channel. And it is goodbye from Richard Wheater.
And it is goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.